welcome to the latest Retire Well episode with me, Matthew. As always, I'm joined by Joe. Today we're going to think about retirement planning for those who are 55, and we're going to think specifically about potential mistakes and common mistakes that we want to help people avoid. So again, we're going to think about the usual financial bits and the traps that people can get into, but we'll also interweave some of our experiences for helping people retire, some of the softer stuff and some of the psychological bits. I've actually got a story from this week where a guy had got in touch recently to say, my pension's a bit like a black box. He's got a defined benefit pension and then a flexible pension alongside it. And he said, I don't know what it's worth. Will it give me the income I want in retirement? He's like, ideally, I don't really want to work too late. So I think he was 55 and he was like, I don't want to work till I'm 57. We wrote away, got all the technical information. And a few weeks later, we had a meeting with him. And I said, good news. Here's the cash flow model. You can afford to hand your notice in today and you can have the income you want in retirement. So you're good to retire. You've done your shift, so to speak. You instantly saw him stiffen up and think, and it was that, I'm not ready. It was the, maybe another year, or looking at his wife to say, now is not quite the right time. And I think the main reason for that was, he hasn't got a plan for retirement. He hasn't got those, lists of things he wants to do. So for me, it's all about the financial bit and the psychological bit knitting together to solve the problem and helping someone to retire. So we can do that bit to say you can afford to retire, but for him, it has to come hand in hand with what he plans to do. And I think crucially, over the next year, he's going to be thinking about what does he actually want to do in retirement, but there'll be a pressure lifted off him in the sense of he's now just working because he wants to, not because he's trying to accumulate more wealth to afford retirement.
Yeah, absolutely. It's that psychological versus financial psychological versus financial readiness that we spoke about so much on the podcast previously.
So moving on to our usual feature, the jargon buster. Today we're going to talk about the money purchase annual allowance, often abbreviated to the MPAA. Again, that's definitely a bit of jargon. Do you want to jump into that one, Joe?
Yeah, so we've spoken about it so much, to be honest, over the past 3 episodes. This is more just almost reiterating that understanding of it, because it is something that a lot of people will misunderstand, especially when it comes to retirement. Essentially, you can think of the money purchase annual allowance as a reduced annual allowance. Annual allowance being 60,000, reducing down to 10,000 with the money purchase annual allowance. And it only does that when you take 1 penny of taxable income from your pension. So if you were to retire at 55, start accessing your pension from tax-free cash only, that wouldn't trigger it. But if you were to take 1 penny of taxable income, it would. I suppose the quirk with it is it doesn't apply to DB pensions. So if you do have a defined benefit pension and you've took the scheme pension, you've got your tax-free cash and you start to take taxable income, that doesn't apply. You've still got the full 60,000. It's only flexible pensions when you take taxable cash. Sorry.
Definitely. And again, you can have some quirky small pots. So again, if someone's got a pension that's worth less than £10,000, you can, in theory, encash that using the small pot rules and not trigger the money purchase annual allowance. So again, it's a useful bit of jargon. And I think the problem we've had in the past is people have unknowingly triggered the money purchase annual allowance, and that restricts their future planning. So I think what we'd say to everyone is, if you're accessing money from a pension, have a second opinion, talk to the provider, talk to a financial advisor, make sure that you're not accidentally doing something that you weren't expecting.
Yeah, absolutely. So jumping into the main topic of sort of looking at what planning mistakes you can potentially look at avoiding at age 55. The first is, I suppose, a little bit of a funny one in the fact that assuming that you can access your pension at age 55. When we speak to clients, the vast majority of people that come in, whether they're 20 or 55 or even older, they'll say, look, I can't wait to start accessing my pensions when I turn 55 because it's been that age for quite a while now. There is a bit of change on the horizon. So from 2028, that is moving up to 57 years old as opposed to age 55. The time that you can access pensions. So essentially it's on sort of an age banded basis of where you're at. If you were born after the 6th of April 1973, sorry, I should say, your pension age will actually move up to age 57 as the first time that you can access that pension, unless a couple of things that I'm sure Matthew will run through now.
Yeah, so people who were saying, that doesn't seem fair, well, it's in line with the state pension age, which is in line with normal life expectancy. So the logic there is, as people are living longer, they're then accessing their pension for a longer period of time. So it's state pensions going up age-wise, and that minimum pension age goes up with it. As Joe points out, there's a few times when you still have that protected age of 55, and that's essentially if you've got an existing pension which has, locked in and protected that age 55. Not all pensions do it. Most pensions don't. But again, some people might have some quirks, especially if you were close to that, date of birth that Joe described there. So someone might say, it was really important to me that I was going to retire early, and therefore they were really important to keep that age 55.
Yeah, I think it's just one of the extra things that you need to have on that tick box of when you are consolidating pensions together, which a lot of people do at age 55, to make sure that you know whether you've got a protected pension age of 55 or not, because otherwise your retirement plans might get shifted back a couple of years.
Yeah, definitely. And I mean, I've got a couple of pensions, and one of mine is protected at 55, but again, I'm not putting into that pension. It was a small legacy pension. So again, you then have got that ability to say, well, in theory, someone could have one pot that they could potentially use, but they could have other pensions that they were going to access in a different way. Again, we talk about consolidation and when and how to do that. The only reason why I haven't consolidated that small pension for me is because of that protected retirement age. In reality, I'm not expecting to retire at 55, so it becomes a bit of a moot point. But for others, it can be really important for them to think about. And in the same way that some people have assumed, state pension has been 65, but really when things have changed, maybe they're 66, maybe they're 67. So for those people, just knowing what your pension options are, when you can access it, and equally what's your state pension going to be and when does it kick in, that's really important.
Yeah, I think the state pension is an interesting one because it's in the news quite a lot at the moment. That it's, I've seen a couple of people refer to it as a Ponzi scheme where current national insurance payers and taxpayers are actually funding the current retirees on the state pension, and as essentially the replacement rate of the UK, not enough people are being born to support future retirees. And I think there will be some form of change in the state pension, particularly over the next 10 or 20 years. What that looks like, I don't know. There's always talk of means testing. I mean, the triple lock is there, which means it can go up by the higher of earnings inflation or 2.5%. Some people see that as unsustainable, but as we've spoke about in previous podcasts, it's a very politically charged topic, and you'd likely lose a lot of votes in the next election.
Yeah, I think COVID was that year when you could have seen the triple lock break, and when it was protected and they kept it, you almost thought, well, actually, is that because politically it's so important? Politically it's so important, so they're really keen to retain it. Again, someone who's retiring at 55, they're a long way off the state pension. So again, one of the potential traps is saying, I've got enough to see me through between 55 and state pension age. Again, you have to think, what income sources? Have I got rental income? Have I got the pension? What am I going to use in the first chapter of retirement to get me through?
Yeah, absolutely. And I think the solace that retirees can take is that there seems to have now been a precedent set where any changes to the state pension, you will have 10 years notice prior to it happening. So you'll still be able to plan. It might just be that you have to change the plans.
Yeah, I guess tweak the plans, again, in the same way that we do with drawdown or other flexibility. It's about basing your decisions on the current rules or current legislation, but having an element of capacity for loss and a tolerance for change, which I think is definitely important. Again, there's a bit of an irony that we're talking about state pension when we're also talking about retiring at 55, but that's the holistic nature of planning when you start to say, what does the big picture look like? And I guess when we think about the psychological bit, we also have got the usual conversations to say, is someone ready at 55? Do they know what the next chapter looks like? We often talk about people who enter retirement who might lose purpose or identity or routine. And again, having people who've thought about that and have a real plan for time can be really important.
Yeah, I mean, I think the retiring at 55, although is probably the right age for a lot of people that we come across, they feel ready. If you worked from 18, that's 37 years in work, and if you live to life expectancy, that's another 32 years to get there.
Yeah.
So it's a big portion of your life, and if you haven't sort of fully thought it through about what you're going to do, what your plans are, do you have any sort of passions that you want to go, it can be quite hard.
Definitely, and I think that goes hand in hand of not thinking what you will spend and what you'll need. Again, planning on the projects, expenditure, holidays, what am I going to do with my time also comes hand in hand with what am I going to do with my money. I had a guy in the office this week who was talking about retirement, and he has almost budgeted while he's still working, what do I think I'm going to need in retirement, and anything above that amount he's putting back into his pension. So again, he's saving more for the future, but he's also getting himself used to living on the income that he's going to have or propose to have in retirement. I've had a few people in the past where they've had high incomes. One guy described himself as having like Hollywood wages, and his biggest worry about retirement was, how do I drop my income and then get used to it and carry on with the same standard of living and enjoyment. And again, that same philosophy worked for him. If you can trial living on that money, even if you're just moving money between cash accounts, you can then be more confident in what your expenditure will look like in retirement.
Yeah, I mean, obviously that client there has noticed that and they've realised it, and they're trying to work around that drop between potentially really high wages and what you might think your retirement income is. I think if you don't do that, that's almost a mistake in itself, because we have quite a lot of people that do come to us and they say, look, I'm retiring at the moment, I might have sort of two incomes, sort of one for each spouse, and they might be taking a good amount, and when you go, right, okay, so you're looking at planning on retiring, what's your retirement expenditure going to be? Usually it's one or two answers. It's one that says, I don't know what my retirement expenditure is going to be, and the other one might be something that is 30 or 40,000 pounds less than they're currently spending, and that creates a real issue, because just because you've flipped into retirement doesn't mean that you're immediately going to stop spending $1,000 extra a month. If anything, quite a lot of people in the early years of retirement actually go up in expenditure because they're taking more time and doing holidays.
I think it's really hard to generalize because everyone's retirement's different, and I think that's the perfect message. It's that element of, will you spend more, less? Well, it really depends. I mean, often a good one is someone says, oh, well, I spend currently this much a month driving to work, so I know I'm not spending that. The bit that you then don't know is, are you going to be spending that much or more going to family members, going on holiday, having the hobbies? So I think that's the bit that it's all about, trying to pull together the thought process of expenditure now, expenditure in the next chapter. How are they different? When we talk to our paraplanners, the technical guys who are looking at the plans behind the scenes and almost teasing out questions or intricacies, one of the things they'll ask straight away is, okay, you currently have an income of that, you think you're currently spending this, what happens to the difference? And again, some people might say, we save it. Again, they might be more disciplined. Other people might go, oh, well, it just gets used, doesn't it? Because it's a surplus. And that's where it's easier to spend someone else's money when you work in. When you then retire, it's your money. And I think that's the balance. I mean, one of the biggest things when people are getting retirement ready is thinking about debt and servicing debt. Again, a mortgage or car loans and things like that, they make complete sense when you're working because you're spreading that payment over a period of time. When you're then in retirement and you transition to retirement, you then can see it as, a noose around your neck where you say there's a constant need to pay out. So therefore I need to constantly bring in money. If it's from a flexible pension, it's a higher withdrawal rates. If you can enter retirement with no debt, then you can see more of that money going straight to me, to discretionary spending, essential spending on the bills, but I've streamlined and slimmed down the expenditure where possible.
Yeah, and that's where you can use that tax-free cash to potentially pay off larger debts, which might be that sort of bridge between what you're spending now, removing the debt, and what you might spend in retirement. And I think it works really well. I want to reiterate what you said that you do with a number of clients, and that specific client of, if you can, the year before retirement, have a look at what you plan to spend on in retirement. Yeah. And just see if you can do it and save any extra into your pension or savings, which A, will give you a bit more wiggle room in retirement, and B, see if you're actually ready to retire on that income.
Yeah, definitely. I mean, not everyone loves a spreadsheet as much as we do, but it's that element of going, just looking at what your bank balance was the day before you got paid, and then the day you got paid the next month. If you're moving your cash around to almost say, I'm planning to live on £2,000 net a month or £2,500 a month, you then go, did I spend more than that? Did I spend less than that? If you just repeat that over 6 months or a year, you've almost given yourself that practice of expenditure in retirement. And then I find that experience gives people a lot more confidence, because I had someone the other day who said, there's a study, by which, and there's a few other places that do what does a comfortable retirement look like? What does a basic retirement look like? And he said one of the things that scared him from not retiring was they were such high numbers. But again, his own expenditure pattern, living up in the Northeast, his cost of housing and other things was a lot cheaper. So almost, he said, I was getting a bit worried that someone was saying I needed 25 grand or 30 grand to live on, when actually, he was like, £1,500 a month was what he wanted. And I think that comes back down to everyone's retirement's different. Don't benchmark your own plans on something in the newspaper or something online or something on YouTube. Actually think about, what does your own income expenditure look like? What's your own capital plans? Someone who's buying a motorhome that's going to cost 30 grand, your pot might be dropping straight away. If you've got that from cash, well, actually your pot's still there to provide the income throughout retirement.
Yeah, absolutely. Moving on, I suppose, to a more technical mistake which might be made is looking at sort of not fully utilising all the tax wrappers that you have available to yourself. This goes back to what we spoke about on a number of different podcasts of some people see retirement and they think pension, and they think I need to draw down from my pension, be it the defined benefit scheme or be it a flexible pension. But it's not always the case. Using multiple different tax wrappers, and where available, if you have a spouse, using different tax allowances can really maximise the amount that you can get from your pensions and ISAs and general investment accounts, maybe completely tax-free. Do you want to sort of run through maybe a couple of the different tax wrappers and how they may interlink?
Definitely. I mean, most people have heard of an ISA where there's, no tax to pay. The only tax will be potentially inheritance tax. When you think about an ISA next to your pension, you can almost think about that in the same way as your tax-free cash, where you've got 2 taps from your pension, a taxable income tap and a tax-free cash tap, and the ISA's just all tax-free. So when we're thinking about retiring early, specifically 55, for example, if someone says, well, actually, I'm ready and I'm 54, a pot of money in the ISA could be that perfect enabler to be used for that first period to get you to 55, or it could be used throughout retirement to supplement your income to try and keep you within your personal allowance from a taxable income point of view. So you're right, it's all about diversification of investments, but also diversification of income options. Again, people might have rental income, they might have cash in the bank that they could actually deplete and use over time, or they might have other things like they're expecting an inheritance or other things. So we don't just think retirement pension, we think holistically, what's your Lego blocks that are going to be used to solve the problem, which is sustainable retirement income.
Yeah, and it might not just be sort of taking an ISA one year, pension the other, because if you potentially take too much from an ISA in the first year, you might pay more tax on your pension if you live a long time. And also equal to that, it's looking at how you actually draw out from the pension. So when Matthew talks about your taxable income tap and your tax-free income tap, a lot of the time people get into retirement and they think, I've got 25% of that fund completely tax-free.
Yeah.
Let's draw it all out now and we can maybe make some of those big purchases, do big holidays. But sometimes it's not always that. Sometimes they just want the cash out of the pension into the bank account. That can come with a couple of different problems, because then you think, what do I actually do with the amount that I've taken out? But equally, if you use up a lot of your tax-free cash now, particularly if we're looking at retiring at 55, you might not have any guaranteed income until your state pension age. And that gives you a good amount of years where you could potentially be drawing taxable income from the pension without paying any tax at all.
Yeah, definitely. I think one of the common traps and one of the common misconceptions with pensions is, I've got 25% from a pension, so I'll have that, please. We try and tell people, you've got that to take as, either a lump sum if you've got it to use towards something, or lots of little lump sums if you want to use it towards lots of different things, or regular income. So the person's desire when they retire to go, press the button, put your tax-free cash in your bank, as we've talked about in previous episodes, you don't really need large cash balances in retirement if your income is broadly in line with your expenditure. So really, it's about tax efficiency and using that for the long term. And I think that's probably one of the things that, people with financial education and employers talking about pensions don't help their employees enough to understand what they could be thinking about and what they could do. But the most tax efficient thing you could do in retirement is draw an income which uses your personal allowance and draw anything else above that you need from tax-free cash or from ISAs or using cash that you've got. And if you repeat that over a number of years, you've not paid any tax, and then you've let your funds in the pension grow. So I think that's where, again, I think my mantra is it's someone making an active decision. Taking the 25% from your pension just because it's available is a bit of a passive decision, whereas actively going, I know it's there, but I'll take it when I need it, is that really powerful tax efficiency.
Yeah, absolutely. And the next mistake, I've got it down here as taking too little investment risk in retirement, but equally there's two sides of the coin. You could potentially be taking too much. The reason I sort of put it as taking too little investment risk in retirement, as we spoke about in a recent episode, is there is the potential that your funds can go down in value. But what I think is some of the risks that other people don't think about is that longevity risk and is that inflationary risk, the risk that your funds aren't going to sort of last your entire lifetime. So that's where almost dialing the risk up a little bit on pensions, and by that I mean maybe moving a little bit more into equities as opposed to bonds and other alternatives, to essentially get a bit more growth within your pension and allow you to almost start spending the growth as opposed to the capital sum. I mean, if you had a £300,000 pension pot and you had 10% growth each year, you could look at skimming some of that 10% growth off the top and you've still got a £300 pension pot. Not saying that 10% growth is what you should get on an investment every year, but just an easy example for me.
Yeah, I think you're exactly right, where the question for someone is, what level of risk can you tolerate? What is your view on risk? But also a pension, what's the timescale? So if someone says, broadly speaking, my income and my expenditure is balanced, and then I've got a section of my pension which I'm almost not expecting to use apart from emergencies or apart from extra fund expenditure, if that timescale is potentially, like you said, might be 30 years if someone's retiring at 55, you then say, well, you can actually tolerate a bit more risk, and historically for the long term you're rewarded for that. So I think it comes down to what someone's willing to do, but it also comes down to their capacity for loss. If you've got no debt, maybe another secure income like a final salary, pension, or some rental income, again, you then start to say your financial picture allows you to be a bit more flexible, but also to take a bit more investment risk. The other side of it, where you said too little, again, we've talked in the past about annuities and guaranteed income sources. It's about solving the income need in the right way for the individual. I think the big risk with too little investment risk is that over the long term, inflation starts to erode your capital, and you actually, you haven't enjoyed the funds yourself, but they have lost their real spending power.
Yeah, I think with the too little, a lot of people do come in with a preconception that they are too old for investment risk when they get to age 55. And I mean, if they've got a flexible pension, they've used investment risk to get where they are. There's no reason why they can't use investment risk to be their friend to get where they're going as well. I think it's definitely something that can be a friend, although you obviously do need to take into account the risks. If you are looking at drawing a large income out of your pension, you might be subject to sequencing risk, where you might sort of start drawing out while the market's down, and then that's going to take a lot longer for your pension to recover. But yeah, I just think it's one to think about and sort of make your own decision on where you land.
Yeah, definitely. And I think it also comes back to what your objective is. A lot of people, where there's a couple, for example, and there might be a pension divide that isn't 50-50, someone might be saying, okay, well, this is providing for me. If anything happens to me, it's providing for my spouse. Again, you can then say, well, actually, do we take a bit more risk, or what's the right level of risk to then ensure that if anything happens to me, that's available to pay across to my partner or to my kids. And again, that's just thinking about the efficiencies of doing that. You want to essentially plan for plan A, but when we think to clients, we're like, okay, what's plan B, what's plan C, how can we protect people as best as possible? The other side of thing, we're talking about investment risk, but when we're talking about income, there's definitely a risk that someone can take too much income, or then their desire to take income from a pension at 55 isn't sustainable. In the past, we've talked about, an FCA type golden withdrawal rate of about 4%. Again, that's studies in the past have been said over a full, long retirement, 4% can be a sustainable amount. We've seen people who then take more because they're front loading retirement, and they might be saying, I'm taking more between retirement age and state pension, so I might be happy to take 6 or, higher, but then you're then risking the funds running out. So if someone came to us and said, I'd like to take 12%, of my pension every year, again, we wouldn't see that as being sustainable. But then on the other side of it, we start to say to clients, okay, your current plans, you're not taking as much as 4%. Again, someone might come in and say, I just want to take a little bit. Again, it's like, okay, well, if you're not going to take that, your pension will grow and grow and grow. What's the next objective? Is it to pass it on tax efficiently, or is it to then in the future take lump sums for gifting to family members? It's all unpicking what someone's plan A, plan B, what's their top objectives.
Yeah, I think that the 4% rule is an interesting one, because obviously a lot of people know about it and they see it as a sustainable retirement. But when you're looking at sort of medium risk investments, a lot of the time they can do 4 or 5% over the long term, which means if you're only drawing that out, you're still keeping that capital value of the pension. And that could have a scenario where instead of running out too early, you end up with I'm going to use 300 again, but another £300,000 pension pot when you die. And how many people want to leave £300,000 worth of experiences or time with the family or holidays on the table at death, as opposed to sort of using it potentially in the early years of retirement, taking a little bit of a high withdrawal rate. So yeah, I think it's an interesting one. I mean,
I think it's a flexible point. I think George Osborne, when he talked about pension freedom and flexibility, he created that you can take what you want when you want, and then the regulator and people thinking about it from a risk point of view go, oof, don't take too much. But equally, as you rightly point, you say, well, don't take too little, find that Goldilocks rate, find that balance. And some years you might take too much, some years you might take too little. As long as you can get your pension to see you through the chapter that you're looking to do, perfect. The biggest risk you think is if you spend too much in the early years, you can damage your pension because you've taken, you've eroded the capital, and then there's a chance that will never recover. And if you were looking at getting to state pension age and then life expectancy, the biggest risk you could have there is to say, okay, I'm not at my life expectancy, I'm 5 years short or more, but if I run out of the flexible pension, I then get what I'm given from state pension or any guaranteed income sources, which for some, again, can be a worrying situation.
Yeah, absolutely. I mean, it might be a bit of a controversial point with it in terms of leaving that 300,000 there, because a lot of people would say, look, I can pass it on to the children and that side of things. There are a couple of people in the industry that will essentially flip that back and make it look as how much of that pension is wasted years that you've worked where you could have retired earlier. It's an interesting way to look at it. But again, as financial planners, we want to make sure that you don't run out prior to the age. That's the bigger risk than keeping it there.
Yeah, I think you're right. It's the balance. I think people have always got the ability to take more in the later years to gift and do things, but it's the opportunity cost. You don't want to be sat there saying, I turned down a round the world cruise, or I turned down a trip to see a World Cup final, or whatever someone's objectives are. Again, it's just trying to say, have I, and I think it comes back to that starting point of, when you entered retirement, were you doing it once and doing it right? Had you thought about it? What was the bucket list? What was the expenditure plan? And therefore, are we still in that parameter of what we're looking to do? People who've gone in with a fuzzy plan that's a bit loose, again, they're more likely to spend more or spend less because they haven't spent the time planning for it. Does that make sense?
Yeah, absolutely. And I suppose the final bit on sort of income and taking too much or too little, a lot of the time when clients do have a high withdrawal rate, they'll essentially not make an excuse, but say, it's fine that I'm doing this because when I get to state pension and I get to those go slow years that we've spoke about previously, they're then going to sort of reduce down the income that they're taking from the pension and replace it with the state pension. One mistake, not necessarily at 55, but maybe at 67 or 68, is that they don't follow through with that plan, and then that can potentially be where you get to a shortfall in retirement.
Yeah, I think we often have people who go I expect to reduce my income when this happens, or I expect to reduce my income. When they actually get to that point, they sort of go, oof, actually, when I thought when state pension kicked in, I was going to feel old. Actually, I still feel, fit. I'm still planning to do those holidays. So I'd rather not reduce my income. And that's fine if you've got capacity in the pension and the plan, but it can then put pressure on it. And I think that comes back to our point on the right level of risk, the right level of flexibility. You don't want to be de-risking a pension at the same time that you're increasing your withdrawal rates, because again, you're then saying there's no chance of that pension lasting for the period you want it to. So I think, cash flow modeling is a brilliant model. We bang that drum to say, you can start and say, this is what retirement might look like. Through that retirement, you're then looking at that on a number of points to say, are we in the parameters? Are we still along the lines? If something happens that's a big change of circumstances, if someone inherited money or if someone passed away, again, that can be a big change to the cash flow model. If someone won the lottery, or if someone gave a big amount of money to help a child going through something like a divorce, again, there's a lot of outside forces that can come into the plan, but the model can be used to ensure that you're spending the right amount of time. I think one phrase that clients use a lot is cut my cloth accordingly. And I think that's fine, because you might say, I'll spend more, I'll spend less. But the problem is, if you have that view and then it doesn't go the way you expect it to, almost spending less becomes living less. And I don't think anyone wants to retire early and then compromise on what the standard of retirement looks like.
Yeah, absolutely. I'm conscious just a little bit of time on the podcast, and I think we've got a fair few more things that we would like to discuss. Sure. So it might actually be worth doing another one of these, potentially looking at maybe retirement mistakes pre-55, post-55, and looking at some in maybe a different bit of context. But I just wanted to jump on to the listener's question of the week to make sure we get that in. This one is, again, it's one that we hear quite a lot when we're speaking to clients, or maybe they don't ask the question and don't know that they can or can't do it. I'm spoiling the question already. Matthew, so can I continue to contribute my pension even when I'm in drawdown?
So simple answer is yes. Again, goes back to that money purchase annual allowance. If someone's taking taxable income, they are reduced down to £10,000 in total, but you equally have to have earnings. You have to have a salary or something that then would allow you to put up to that £10,000. So if someone has retired fully and their only income is rental income or pension income, they're restricted to just putting in £2,880 into a pension, and the government would drop in £720 worth of tax relief. That's a really good plan. One, because you get 20% from the government for free, but we can also, as we've talked about in the past, it can be good for using people's allowances. So again, if you've got a couple where one pension might be smaller than the other, if someone's drawing an income to use their allowances, they can also be topping it up that amount I described to help use the efficiency. So yeah, we've got a number of clients who plan for it and continue to put money in. The question I always ask people in that scenario is, why are you putting money in if you're also taking money out? Because you could skip the middleman and you could keep it for yourself and then take less. But I suppose they would then lose out on the tax relief. So it's almost, what is the plan and why are we doing it? And it should be an active decision.
Yeah, I mean, it comes down again to what we keep saying. Everything's very personal. It comes down to what the objectives are. It can make sense for some people and doesn't make sense for others. I think that's quite a nice place to sort of end off on there. If you have any sort of questions with regards to what we've run through today, you can always leave a comment down in the comment section or send an email to retirewell@wealthadvice.co.uk. But other than that, any other sort of topics that you want us to discuss, just let us know. Thank you very much for watching, and we'll see you again next week.